perspectives. Your go-to source for global trade. Your go-to source for global trade. Gotta mock you.
Hey everyone, welcome back to Anafram Market Perspectives. It's Friday, and that means it's time to wrap up the week and take a closer look at how the markets performed. Here's what we're covering today. First, we'll start with a full S&P 500 performance review. We'll see who came out on top, who struggled, and what key trends shaped the market this week. Then we'll break down the impact of interest rates, inflation updates, and major financial events. Did things play out as expected, or did we see any surprises? And of course, we'll check back on our Monday stock observations. How did they perform? Were there any key takeaways we should keep in mind? Now, just a quick reminder. This isn't financial advice. We're here to help you understand the market so you can make informed decisions for yourself. And before we dive in, we want to hear from you. Got a stock or a topic you'd like us to watch for next week? Drop your thoughts in the comments. We'd love to know what's on your radar. If you're enjoying these insights, hit that subscribe button and share this with others. Now let's get into what happened this week. All right, let's start with a deep dive into the S&P 500's performance this week. The market had a wild ride over the past few days, with some sectors seeing big wins while others struggled to keep up. There was plenty of movement across the board, whether it was tariff fears, interest rate speculation, or corporate earnings. So let's break it down. Who were the biggest winners and losers this week? The biggest winners. This week, healthcare sector, pharmaceuticals and biotech. Healthcare stocks stood out as some of the strongest performers, with pharmaceutical and biotech companies leading the charge. Investors shifted their money into defensive sectors, looking for stability as tech and consumer cyclical stocks took a hit. AbbVie, up 5.23%. Investors were optimistic about AbbVie's immunology and oncology drug pipeline, which continues to see strong demand. Pfizer, PFE, up 2.54%. The company reassured investors with solid long-term growth projections, even as COVID-related revenue declines. Merck, MRK, up 5.37%. Keytruda, one of its blockbuster cancer drugs, remains a key driver of growth. Gilead Sciences, Gilead, up 4.18%. Investors responded positively to new FDA approvals for the company's latest drug treatments. Why was healthcare such a strong performer? Because investors moved into defensive stocks amid market uncertainty, and pharma and biotech stocks continue to see steady demand, regardless of economic slowdowns. Energy sector, oil and gas. Energy stocks gained ground this week, fueled by rising oil prices and stronger than expected demand. ExxonMobil, XOM, up 2.53%. Oil prices remained elevated, helping oil producers post strong revenues. Chevron, CVX, up 1.05%. A strong dividend yield and solid production numbers kept investors interested. Why was energy up? Oil prices climbed as geopolitical tensions continued to impact global supply, and investors saw energy stocks as a safe haven play amid inflation concerns. Financials, a few bright spots. While the banking sector struggled overall, a few financial stocks bucked the trend. Visa, V, up 5.23%. Strong consumer spending supported higher transaction volumes. Verizon, VZ, up 5.08%. Telecom stocks became a defensive play as market volatility increased. What's the takeaway here? Some financials benefited from strong consumer spending despite rising interest rate concerns. Now, the biggest losers. This week, technology, tough times for software and semiconductors. Tech stocks had a rough week, with many of the biggest names seeing steep declines. Investors rotated out of high-growth names as interest rate fears resurfaced. Oracle, ORCL, down minus 3.01%. Weak growth in its cloud business raised concerns about future demand. Adobe, ADBE, down negative 3.83%. Increased competition in AI-driven software weighed on the stock. Palantir, PLTR, down minus 14.10%. The stock plunged after reports that government contracts could face budget cuts. CrowdStrike, CRWD, down minus 10.00%. Cybersecurity stocks saw pressure as investors rotated into safer sectors. Why is tech down? Interest rate fears are putting pressure on high-growth stocks, and some companies are seeing cooling demand for AI-related services. Semiconductors, a tough week for chips. After months of massive gains, semiconductor stocks finally saw a pullback, led by a few notable names. Broadcom, AbbVie, down negative 7.57%. Concerns about a slowdown in AI chip demand hurt the stock. Qualcomm, QCOM, down minus 3.70%. Weak smartphone sales impacted its earnings outlook. NVIDIA, NVDA, down minus 0.25%. A slight decline, but still notable given its huge run-up over the past year. Why did semiconductors struggle? AI chip demand is still strong, but some analysts are calling for a slowdown. And also, investors took profits after a major rally in chip stocks over the past few months. Consumer cyclical, a brutal week for retail and automakers. Retail and auto stocks struggled this week as investors worried about consumer demand and potential tariff impacts. Amazon, AMZDN, down negative 6.76%. Slowing consumer spending growth hurt momentum. Tesla, TSLA, down negative 5.91%, facing pricing pressures and rising competition in the EV market. Home Depot, HD, down minus 6.66%. Concerns about a slowdown in home improvement spending. What's happening in consumer stocks? Retail sales data came in weaker than expected, raising demand concerns, and also automakers are facing higher tariffs, impacting their supply chain costs. So what's driving these market moves? Investors rotated into defensive sectors like healthcare and energy as market volatility increased. Tariff concerns hit automakers and semiconductor firms, leading to major losses in those industries. Rising interest rates put pressure on tech stocks, particularly in AI and cloud computing. Retail and consumer discretionary stocks struggled as consumer spending showed signs of slowing. So, what's next? This week's market saw big shifts in sector performance as investors adjusted to new economic realities. Looking ahead, here are 3 key things to watch. Federal Reserve's next move. Will interest rates remain high, or will we see a cut? Trade policy updates. How will new tariffs impact key industries like semiconductors and autos? Big tech earnings. Will companies like Apple, Google, and Microsoft rebound next week? What's your take on this week's market moves? Are you rotating into defensive stocks, or are you still betting on tech? Drop a comment below and let us know. If you're enjoying these insights, hit that subscribe button and share this with others. Now let's move on to the next segment. Hey everyone, let's talk about one of the biggest headlines this week. Trade tensions are back in the spotlight. Former President Donald Trump has announced a new round of tariffs, and if history is any guide, these could have major implications for markets, businesses, and consumers alike. So, what's happening? Here's what we know so far. A new 25% tariff on auto imports, semiconductors, and pharmaceuticals. This is a major escalation, especially for automakers and tech manufacturers relying on global supply chains. A 10% across-the-board tariff on Chinese goods. This move aims to reduce dependency on China, but could raise consumer prices. Reinstating a 25% tariff on steel and aluminum imports, a direct hit to the construction and manufacturing industries that rely on foreign metals. Now, what does this all mean for the economy and stock market? Let's break it down. Who benefits from these tariffs? U.S. steel and aluminum producers, Domestic production might get a boost. Companies manufacturing inside the U.S. as they avoid the extra costs of imported goods. Potential boost for alternative suppliers. Mexico and Vietnam could see increased demand for manufacturing. And who loses? Automakers. Companies like Tesla, General Motors, and Ford could see rising production costs. Tech companies. Semiconductor producers like Broadcom, AVGO, and Qualcomm, QCOM, rely heavily on global supply chains. Retailers and consumers. Higher import costs mean higher prices for everyday goods. Question for you here is that, are these tariffs a strategic move to protect U.S. industries, or are they pure political posturing ahead of the elections? Drop your thoughts in the comments. All right, now let's shift gears to some major headlines that moved the markets this week. Gold surges to record highs amid tariff fears. Gold prices skyrocketed to an all-time high of $2,942.70 per troy ounce, up 7% since Trump's announcement. Why? Investors are rushing to safe haven assets as fears of a potential trade war escalate. Historically, when tariffs disrupt global trade, gold tends to shine. Mexico's auto trade surplus with the U.S. hits a record high. Despite trade tensions, Mexico exported a record $181.3 billion in auto-related goods to the U.S., marking a 6% year-over-year increase. This reinforces Mexico's position as a manufacturing powerhouse, benefiting from supply chain shifts away from China. Vanguard's VOO ETF overtakes SPY as the largest S&P 500 fund. Big news in the ETF world. Vanguard's VOO ETF has officially surpassed SPY, holding $631.8 billion in assets. This highlights the growing shift toward lower-cost ETFs as more investors move away from high-fee funds. Key economic indicators to watch. Let's now break down this week's key economic data releases and what they mean for the markets. These indicators provide critical insights into the direction of inflation, economic growth, and central bank policies, all of which impact market movements. The U.S. inflation rate, CPI, at 3.3% year over year. The latest Consumer Price Index report shows that U.S. inflation increased by 3.3% year over year in January 2025, slightly higher than the previous month's figures. The core inflation rate, excluding food and energy, remains elevated, suggesting that inflationary pressures are still present in key sectors like housing and services. So, what's the market impact? A slight increase in inflation could lead to a more cautious Federal Reserve stance, delaying rate cuts. Higher inflation impacts consumer purchasing power, which could affect retail and discretionary spending. Markets may experience volatility as investors reassess expectations for future Fed decisions. FOMC meeting minutes. Fed signals. Higher for longer on rates. The latest FOMC meeting minutes indicate that Federal Reserve officials remain cautious about cutting interest rates too soon. Several policymakers expressed concerns that inflation could reaccelerate if they ease monetary policy prematurely. Few key takeaways. No immediate rate cuts. The Fed remains in a wait-and-see mode. The labor market remains strong, giving the Fed more flexibility to keep rates higher. Some Fed officials are concerned about sticky inflation in key sectors, like housing and wages. What does this mean for investors? Tech stocks and growth stocks may remain under pressure as high interest rates impact valuations. Bond markets could see further volatility as traders adjust their expectations for future rate moves. Also, Japan's core CPI hits 3.2%. Will the Bank of Japan finally hike rates? For the first time in over a decade, Japan's core inflation rate has remained above 3% for several months, sparking speculation that the Bank of Japan, BOJ, could soon raise interest rates for the first time since 2007. So what's the market impact? A rate hike from the BOJ could lead to stronger Japanese yen gains and impact global currency markets. Japanese exporters like Toyota and Sony may face currency headwinds if the yen strengthens. Global investors are watching whether Japan finally moves away from its ultra-loose monetary policy. In Mexico's GDP contracts by minus 0.6%, This quarter, Mexico's gross domestic product, GDP, contracted by minus 0.6% this quarter, marking the first quarterly decline in over a year. The slowdown is being attributed to weaker industrial production and a decline in auto manufacturing exports to the U.S., a tightening credit market as interest rates remain high, lower than expected consumer spending growth as inflation continues to pressure household budgets. So, what does this mean for Mexico? Investors will closely watch the next quarter's data to see if this is a temporary slowdown or a sign of deeper economic weakness. The Mexican peso could face volatility, especially if the GDP trend continues downward. Mexico's strong auto trade surplus with the U.S., as discussed earlier, may help stabilize future growth. Why does this matter? Inflation trends will likely impact Federal Reserve policy, affecting global interest rates and market conditions. A potential rate hike from Japan could shake up currency markets and affect global trade flows. Mexico's slowing GDP growth raises concerns about economic momentum in North America, particularly given Trump's proposed tariffs on Mexican goods. Market participants will be watching these indicators closely as they will shape the outlook for the second quarter of 2025. Earnings season continues, and this week delivered some major surprises. Let's break down the key winners and losers from the latest reports and see how companies are navigating this volatile environment. Let's start with the biggest earnings winners. Alibaba, BABA, a massive beat. The Chinese e-commerce giant reported EPS of $21.39, well above expectations of $19.81. Revenue also came in strong at $280.115 billion, surpassing the expected $277.3 billion. This signals continued growth in its e-commerce and cloud computing divisions. Booking Holdings, BKNG, travel demand remains high. The company crushed earnings expectations, posting EPS of $41.55 versus the expected $36.13. Revenue reached $5.47 billion, well above forecasts of $5.19 billion. Mercedes-Benz, GAF, luxury demand stays strong. Mercedes-Benz outperformed expectations with EPS of $2.57 versus the projected $2.18. Revenue hit $38.45 billion, surpassing the expected $37.92 billion. Key takeaways from earnings winners. Alibaba's strong numbers highlight continued demand for online shopping in China and international expansion. Booking Holdings' travel sector momentum suggests a robust post-pandemic recovery in global tourism. Mercedes-Benz's luxury vehicle sales remain resilient despite economic uncertainties. And the biggest earnings misses, Rogers Corp, ROG, a disappointing performance. The company posted EPS of 46 cents, well below expectations of 84 cents. Revenue also came in lower than expected at $192.2 million versus $211.75 million. New Holdings, NEW, fintech slowdown? New Holdings reported EPS of 0.1129, slightly missing the expected 0.1223. While revenue did beat expectations at $2.99 billion versus $2.74 billion, the EPS miss suggests increasing pressure on margins. Key takeaways from earnings misses. Rogers Corp is struggling with weakening demand in key industrial sectors. New Holdings' fintech growth is slowing, reflecting a competitive market and macroeconomic uncertainty. Before we wrap up, let's highlight 2 stocks and 1 ETF to keep an eye on next week. Again, these are not recommendations, just interesting case studies to follow. Stock number 1, Adeia, ADEA. Surprising strength in earnings. The company beat EPS expectations, reporting 47 cents versus the projected 42 cents, with revenue also outperforming at $119.2 million versus $113.93 million. Investors are watching whether this momentum can continue. Stock number 2, Alibaba BABA. After its strong earnings beat, will Alibaba continue its rally? Analysts are watching closely to see if this momentum carries into next week. Bonus ETF, Vanguard S&P 500 ETF, VOO. It officially overtook SPY as the largest S&P 500 ETF, with $631.8 billion in assets under management. This reflects strong investor interest in lower-cost, broad-market ETFs. What stocks are you watching next week? Drop a comment below. That wraps up this week's Anafram Market Perspectives. We covered the S&P 500 weekly winners and losers, broke down Trump's tariffs, analyzed key economic indicators, and reviewed this week's biggest earnings reports. Some key takeaways. Markets remain volatile, with tech and consumer cyclicals struggling, while healthcare and energy sectors gained. Trump's tariffs are shaking up trade policy, and we'll keep an eye on their impact in the coming weeks. Earnings season delivered surprises, with Alibaba and Booking outperforming, while Rogers Corp and New Holdings fell short. So, what's next? Don't forget, we'll be back on Monday with a fresh outlook for the week ahead, where we'll analyze the S&P 500 market map to start the week. Key economic events to watch. Our 2 stocks to observe for the week. Not recommendations, but interesting case studies. Before you go, like this video if you found it helpful. Subscribe and hit the notification bell so you never miss an update. Drop a comment below. Let us know what stock or topic you'd like us to cover next week. Thanks for watching, and we'll see you Monday for our next market update.
Thanks for watching. If you found this valuable, hit subscribe and share this with others. See you next time on Anafram Market Perspectives. Next time on Anafram Market Perspectives.